Hello, welcome to Satovsky Asset Management Sam Hall's town meeting, our first attempt at a video conference in order to give some education and information about what's happening in the state of the world, health, financial, and the like. Appreciate everyone joining us. This will be recorded for those that aren't able to participate, that we can share. And most importantly, I just want to use the opening moments to say our hearts and minds go out to everyone to be healthy and safe during this challenging moment in time. And whether it's a day, a week, a month, 6 months, whatever it happens to be, in isolation and time that you have with your family to stay healthy. So as a culture and a firm, I want to reassure everyone that we actually had to do business continuation planning and succession during the Hurricane Sandy. So our business and operations have been functioning smoothly. Nobody was in the office on Monday. We actually had it scheduled in advance as a test, not knowing this event was going to happen. So everybody's working remotely. We're able to log into all our systems, all of our operations from business partners and the like are all functioning fine and smooth, and communication lines are open for us to communicate as a team, as well as to be able to be of service to those that we're fortunate to serve. So we'll get through this together. So I'll jump right in. As the opening, we have it scheduled for an hour, but we'll leave some time at the end. If people have questions on anything that I share or Jason shares, you're all welcome to inject questions via, there's some that came in previously, but people can, there's a chat function on your system, on your Zoom screen, so you can direct a chat inquiry. We may not be able to get to all of them, but certainly we will do our best to address any specific questions on anything that's top of mind for people or that comes up as we go through our prepared presentation. So interestingly, I was preparing this presentation for a couple of weeks ago, and the moment in time, again, before I knew this virus outbreak was happening, I was thinking about the cultural diversity of America, and the Statue of Liberty struck to mind is the idea that there's a plaque on the bottom, an Emma Lazarus poem that says something to the effect of, "Give me your tired, poor, hungry, yearning to breathe free, and let me be the light upon your golden door." So I don't know why that struck me, but at this moment, the diversity of everyone yearning to be able to have, freedom, health, and someone says they can't see me. That's interesting. Can everyone see me? I have my video up. Nonetheless, if other people can't see me, there's a tab function on to be able to look at gallery view rather than just look at the screen sharing. So it should be on your controls. Okay, great. Okay, so with that, I'm gonna hop right in. These are some disclosures as normal. Nothing that we put together here is specific advice. Everyone's situation is different. There's a lot of data and information. Past performance is no guarantee of the future, obviously. And there's a whole lot of other disclosure that for legal and compliance purposes, we have to put forth. I want to start with a quote. I like quotes. As you said, why do you need quotes and motivation? You don't need a bath every day either, but it certainly helps. So in times like this, an excerpt from the poem If by Kipling really struck me, is that if you can keep your head when all about you are losing theirs, yours is the earth and everything that's in it. For those that are interested in seeing the whole poem, it was quite profound. I'm sure you can look it up on your own, but it struck me that at this moment in time, for anyone that's on the call that has family, friends, that runs businesses, keeping your head cool while everyone's losing theirs, it's a critical component to be able to have a healthy mindset for yourself and all the people that are in your life for whatever is next. Quickly into the facts. This was the fastest bear market ever. In 19 trading days, the market up until March 11th had declined, a bear market being measured as a 20% decline. From the last crisis in 2008, 2009, we did have several 19% declines, but no 20% decline, both in 2011 and late 2018. But this officially broke through the 20% marker that measures a bear market. I think in a weird anomaly, a lot of people were rooting for the end of the bull market in order to be able to move forward. Everyone was on pins and needles waiting for an excuse for things to drop. So we can create all sorts of excuses of why this happened so quickly, so fast, but it did. And you can see visually how quickly and how sharply things have fallen in a period of 19 days. In fact, Thursday, after the quickest fall in markets speed in markets history, we had the 5th largest decline, 10% decline on Thursday. The other several occurrences happened in other crises, as you can see. And this graph is a visual depiction of fear. This is a fear gauge. I talk about it often on my video blogs, but the fear gauge is an indication of, for technical jargon, put and call ratios, people actually placing bets to be able to protect from further losses or betting on gains. Historically, as you can see, under normal conditions, it floats between 15 to 20. And as of yesterday, we hit 75. And as you can see visually, the 75 on the fear index was last hit in 2018. Sorry, 2008, I apologize. So is this unusual? And this is just a recent data, but historically, there are 5% declines about 3 times a year, 10% declines once a year, 15% declines every 4 years, and 20% declines every 6 years. So this does happen. It happens when people least expect it. It doesn't happen when everyone's expecting it to happen. And as you know, I'm fascinated with behavioral science. So when everyone expects something to happen, something different is going to happen. So be careful about extrapolating recency bias into whatever the future may hold. And historically speaking, I know, this is a chart that most people, are like, ugh, this is the same nonsense I always hear. Well, after declines, markets have typically rebounded a year, 3 and 5 years forward. It's a very common occurrence that when people are most fearful, the opportunities are the best. So now let's get into some facts about the virus itself, history, education, and perspective. And I'm going to turn it over to Jason, Jason Blumstein, who's fortunate we're welcome as a member of the SAM family and the SAM team almost a year and a half ago. And he had an amazing history over a decade at JP Morgan and at Morgan Stanley, and has been tremendous addition to the team. As and many people have met him will know, he's got a very thoughtful mindset, and more importantly, is great on operational research and investing perspective. So take it over.
Thanks, John. So what we did is we went back and try to keep minds on perspective. A lot of times when people are investing, we have a tendency to think about what's happening now, right, and lose perspective on what has happened before, right? And they always say that history doesn't repeat, but it tends to rhyme, right? So what we did is we took a look at past viruses that have taken place. Nobody knows how this one's going to react, but what you can see here is we looked at 6 different viruses that have occurred throughout time. The one that people are saying is the one that could be most resembling of the current virus is the Spanish flu, which happened from 1918 through 1919, where it affected 27% of the global population, and approximately 40 million people died globally. In today's numbers, that would be 100 million. So what you can see from that perspective is that during that time, there was very little market reaction. One of the potential reasons for that is that's because we were at where that was during World War I. So if you looked at before we entered World War I to the time the Spanish flu started to hit, the market already declined 30%, which is roughly what it's declined so far. So you saw a correction before the actual virus took place. Then you see other viruses, SARS, avian flu, H1N1, most recently Zika virus, which the market declined 12%. The one thing that's very interesting to us when we look at this is that when you look at the second column there, it says from the trough when the market bottomed to 1 year later, you saw substantial rebounds post. Now, no one knows what's going to happen during this crisis. But the other interesting slide is that even from when the outbreak took place, the start of the outbreak to 1 year later, the market was also positive. So again, just trying to frame that perspective that even though this feels very painful while we're in it, we have, something like this has taken place before, and history tells us that we all will get through this together. Next slide, Jonathan. So this is just a visual depiction of the data that I just presented, mainly showing the other viruses that I displayed outside of the Spanish flu. We couldn't get the chart all the way back to 1918. But what you see is that the market, as it says there, the market continues to choke through and power through viruses. There is a time frame where emotions run high and people have uncertainty, and that's typically what you see in the marketplace. Markets don't like uncertainty. Human beings don't like uncertainty. But once there's a little bit more uncertainty, the markets power through. Next slide. Now this is an important slide. I do not pretend to be a doctor whatsoever, but we thought it would be helpful perspective on what's taking place in our society today and what we think is going on. My sister is a medical professional. She's a emergency room pediatric doctor at Miami Children's, and she talked to me about this a week ago. And I was on a call with a lot of top medical professionals in my community last night that also mentioned this, right? And what's going on right now is a concept called flattening the curve, right? And the biggest issue from everything that I read and hear is that it's not so much will people get this virus, it's a matter of if everyone gets it at the same time, right? So if everyone sort of gets it over time, we'll have the healthcare capacity to save a lot of lives, versus if everyone gets it at the same time, you can overtake the healthcare system, and that's really the big issue, right? So when the markets see and people see schools shutting, my kids don't have school for the next 3 weeks, right? When people see the NCAA tournament stopping, NBA stopping, all these different things taking place, the reaction of what's going on in society is we're just trying to flatten this curve, but it's the market is reacting. We've never seen this before. There's so much uncertainty. So this is what society is trying to do. Some statistics is that there's a thing called the spread rate, right? And again, I'm not a doctor. I'm just going through what the conference call was on last night, is that there's a concept called the R naught, which is the definition of the spread rate. So if you keep that spread rate at 1, which is just one person affecting one person, right? It will take 5 million years to affect the population, right? So plenty of time. If that increases to 2, so if you're in a crowded area with a bunch of people and you affect multiple people, it will only take 6 months. So that's essentially what we're trying to do is to lengthen this curve. Next slide, Jonathan. And what you see is that this is what has taken place in China with all the aggressive actions that they have taken, right? So the virus started to outbreak in China at the beginning of January through February, saw a lot of spikes, and then they put on a lot of isolation methods. And what you've actually seen is that recently the number of new cases has fallen dramatically. Next slide. Again, and this is sort of where we are in the US. So if you see in the US, we're at stage 2, where this is spreading locally. And there's essentially what McKinsey has put out is that there's 5 different stages. And what you can see in the far right is that China is already at stage 5. It's taken them about a month to get there. But the US right now is going through stage 2. And again, if you read about what's going on in China and listening to the news right now, Apple has already opened up all their operations in China. Starbucks has opened up all their stores. So business is getting back. People are getting back in China. It's just right now in the US, we're going through this and trying to all together sort of flatten the curve. Next slide. And at this point, Jonathan, I'll pass it back on to you.
I just want to mention one thing on this last slide is, Italy is in, didn't necessarily prepare well. That's why everything is sort of on lockdown. So it's very important at this moment in time for everyone's hope that our government takes proper action in order to minimize the impact of this spread and get people properly tested and the like. And the likelihood is that most people that have the virus or come in contact with someone with the virus, there is a 14-day period of quarantine. And I happen to be traveling in Florida for a wedding last weekend. So just as a precautionary measure, I've carved out my own space and I'm quarantining myself and my own family. I don't have, coronavirus, but there's no reason to put people in harm's way. You want to realize that a lot of this isolation of the NBA and the NCAA and these things shut down is going to create a risk for mental extrapolation of things. So forgive me for getting philosophical on you, but oftentimes we're running, and man is sacrificing his health in order to make money, and then sacrifices money to recuperate his health, and so anxious he doesn't enjoy the present. So, and then lives as if he's never going to die, and then dies having never really lived. So this is a very reflective moment for everyone. And forgive me going back to the root of psychology, Maslow's hierarchy of needs, but this reminds everyone of the importance of planning. Obviously, everyone needs physiological safety, food, water, somewhere to sleep, clean air to breathe, and safety, both financial safety and health safety. And, those root things are right now being called into question for a lot of people. So, hopefully people have done a good job of, when you start hearing stories about businesses really being massively impacted, we've been trying to apply the lessons we learned from helping businesses have liquidity and lines of credit to be able to get through difficult periods of time. The same principles should apply to a person's financial balance sheet and financial planning in order to be able to weather situations like this. And you have to recognize, particularly if you're sitting home and you turn on the news, fear sells, and there's going to be a lot of fear that is going to be, hitting your amygdala at a very rapid pace. And as anyone that's read Canan and Tversky's, Thinking Fast and Slow, there's been a Nobel Prize given for this concept. Our human system has a 2.5 to 1 loss aversion. So the fear of losing money is 2.5 times the magnitude of the pleasure of making money. So right now, everyone is, at maximum fear. And the fact that the VIX and the volatility index has been above 50 for over a week, it's an extenuated period of fear that really starts to wear on people. So this is for my own health and well-being, a number of years ago, I stumbled upon this guy, Ched Mantan, who was the 5th guy in at Google, started an organization called Search Inside Yourself. Instead of searching Google for the answer, the idea of searching inside yourself is the idea of being able to find a way to quiet your mind and get to a point of inner peace, inner calm, inner peace, and compassion, inner happiness and compassion for yourself and compassion for others. And why that's important at this moment in time, more than ever, is that everyone individually has to focus on what they can control. We've been fortunate that we've done a lot of preparative things on the financial side to be able to have a seamless business, to make sure all of our employees are healthy and safe. Some businesses may not have prepared quite as well, but every single person in society and culture has a responsibility to be able to get to a better mental place. And you can have a choice. You can either spread fear or be a positive influence on your family, your friends, and coworkers to be able to gain a little healthier perspective that things will get through this, whether it's a day, a week, 2 weeks. And here are some habits that, you know, I've been practicing and learning. It's not easy, but the first one is to meditate over medicating. I think a lot of people may, for the benefit of, you know, sedating themselves during these stressful times, I think that many people may take a lot of drugs and alcohol and a lot of things, but, you know, I'm trying to stay healthy. I'm trying to work on quieting my mind. And for those that haven't ever meditated before, it's a great time to turn off the TV in 14 days and get into a meditation practice and learn how to breathe, learn how to calm the nervous system. And the reason that's important, I mean, there's a lot of reasons it's important, but the most important reason is that the way that we're neurologically wired, we all have this amygdala brain where that we get into fight or flight very quickly. The lizard part of our brain immediately, as if we're on, you know, the prairie going to get eaten by an alligator or a lion, we go into fight or flight. And neurologically, as you could see in the bottom right-hand corner, it shows up in your body. So particularly when people's immune system is worn down, their neurology and their internal chemistry doesn't allow them to be able to show up with a clear mind and a clear perspective to make decisions. And a couple of years ago, I was fortunate to hear a speaker on hostage negotiations, and you learn that the higher the emotional fragility, the lower the rational thinking and decision making. So it's critically important to meditate or do something to get your emotions in check so that you can get space to be able to make better decisions. And the quote here is from Viktor Frankl: between stimulus and response, there is a space. A space is our power to choose our response, and in our response lies our growth and freedom. So we don't know whether this is short-lived or long-lived, but every single person involved that we've been fortunate to have an influence and impact on, hopefully you can impact the people in your lives in this simple but constant practice. As many of you know, I had written a book about this concept because whether it's now or at any moment in time, there's an invisible cancer in finance that people don't want to talk about. Everyone wants to talk about fees and performance and how people are doing, but what they don't talk about is creating the right structure for someone to live healthy, wealthy, and wise over a lifetime, and focus on planning on a balance sheet to be able to minimize this behavioral gap. If good planning is done, we can try to minimize it the best we can and reduce some behavioral biases and tendencies that people have. Why is this important? This cumulative impact of emotional decision-making, this is not today, it's not new, this has been going on forever. The average investor makes a lot of behavioral decisions over time because of their fight and flight and response, and easily get seduced by the news. So our goal is to focus on facts over fear, a mindset of abundance over scarcity, and if we can accomplish this, then as the Emma Lazarus quote, you know, started the presentation, we can all seek our own freedom and safety. And so a couple of tidbits around planning. The reason for a retiree we focus on a 3% spending rate isn't because we only are expecting 3% returns. It's because we want to be able to put someone in a position, if they retired at 65, to have their money last over their lifetime as if it was an endowment, and to weather declines. And as you can see by this graph or this visual, this would enable someone, if they retired out of the gate, to experience in 1973, 1974, close to a 50% decline. And if your spending rate was under control, you can weather it and not worry about living through a hurricane. But if your spending rate is too high, you then become a lot more vulnerable to short-term moments in time. For someone younger, this is a great opportunity to get into better habits about saving and donating to others, and, you know, accumulating money for your future. Even if you're a business owner, carving out money to not be dependent on your business Heard a conversation yesterday about someone who owns a villa in Italy, and they have 90% cancellations, and they're likely going to be shutting down. Well, if you have all of your eggs in one basket and you haven't diverted money to other businesses and you're dependent on that sole asset for your livelihood, it makes someone quite vulnerable. So even if you're a business owner where most of your wealth is in your business, carving money out for other things are very important. Forgive me for getting nerdy and showing you my quant thought process, but the reason why I tie it together in the planning perspective is to show you real examples. These are not real people, but representative of the kind of things that we come across, showing you a 10-year time horizon. The top scenario shows, someone's net worth, their cash flow, their lifestyle needs, their spending, what they would need in assets to be able to support that spending in perpetuity, as well as their investable assets. So in the first top left corner, you could see someone needs $6 million to retire based on a $15,000 a month spending rate. 10 years later, they've done great. Their net worth is up 7-fold. Their investable assets are up 7-fold, but their spending is up 4-fold. And with spending up 4-fold, they're still not quite in a position that they can live healthy, wealthy, and wise, because they need to, create an equilibrium there. And we've been fortunate to serve some endowments, and the endowment principle is that most endowments have a 4 to 5% spending rate, plus they want to cover inflation. Inflation is real. Inflation hits us in healthcare costs, in building maintenance, in rising cost of talent, technology, innovation. There's a lot of things that happen. So in this example, even with a doubling of a net worth in the last decade, with double the spending, there's still a required 8% spend rate. I'll come back to why that's pertinent. So getting into the evidence, I know I'm being redundant for those that have heard me talk about this before, but instead of thinking about the market, think about ownership stakes in businesses. If you own a business or have an ownership stake in businesses over time, not all the time, but over time, ownership stake in businesses outperform cash and T-bills. Value historically has done better than growth. Small has generally done better than large. And highly profitable businesses have been the most persistently doing better than less profitable businesses. These things work over time, not all the time. And just a quick highlight, you can see, if I could avoid the red and avoid anyone losing money, I would love to have everyone in cash and not have anyone lose any money these last 2 weeks. But I don't have that foresight to know how to dodge in and out day to day, week to week, quarter to quarter. So we have to create a good structure on someone's balance sheet so they can get through periods of discomfort. Same with value and growth. You can see it doesn't always work. Small over large doesn't always work. It works over time, but not all the time. Highly profitable, same concept. So I know my team didn't want me to share this, that they thought I was going to lose everyone on the technicalities, but with the 10-year treasury or the 30-year treasury, just 2 days or earlier this week, getting to 0.9%, under 1%, the implication or the implied ownership stake in businesses over a decade is to earn 8 to 10%. And you could see in the last crisis back in 2000, the top right corner, in 2008 to 2018, the implication after the crisis was that markets would average 8%. They ended up averaging 10. Leaning to small, cheap, and profitable companies added 12. And Berkshire is actually using a perspective of value investing has actually underperformed the market. So if you take that same implication going forward, you should get 8 to 10% returns in the decade ahead. Again, it's no guarantee, but you have the possibility. You certainly, at 10-year treasuries at 1%, you have no possibility of compounding anyone's money to cover their spending plus inflation and taxes. Here's the 10-year chart of value. So the reason I highlight this is to pick on, Warren Buffett and Berkshire Hathaway, which we own for many people, and to highlight the idea that, look, I'm not the Oracle of Omaha, but he's been historically the best investor the last 50 years. And just using the graph of the last 25 years or the last 20 years, you can see that 40% of the time, not only he lost money, but he underperformed the market by magnitudes of 4 to 59%. This visual only showing 40, but there's been massive periods of underperformance. So our focus has been leaning more toward the most highly profitable businesses. And the reason I wanted to highlight that today is because to be able to do this presentation, I'm on an Apple computer. I get an Amazon package delivered at my home every day. I'm using PowerPoint, which is a Microsoft product. I'm communicating with people on my, Verizon cell phone. I'm using my Visa and my MasterCard to be able to charge things. Cisco is what's enabling the 53 participants to be connected, routing the internet so that we can communicate seamlessly. Merck and Johnson & Johnson are pharmaceutical companies. As you can see internationally, the most profitable businesses include Roche, Novartis, GlaxoSmithKline, AstraZeneca. What's fascinating is Roche just got approved, I think today, if I read correctly, that they are going to be providing test kits for free. I have a scratch, tissue. Don't touch my face. Anyway, people, of course, Diageo, people are going to be drinking and smoking, so Diageo will benefit, I'm sure. Nestle, people are going to be eating a lot of chocolate. So life does go on. Again, instead of thinking about the markets, think about owning stakes in businesses. Obviously, over time, that has historically worked. But the one thing that, going back to my meditation and why it's so important to calm your nerves and to find a way to get to a degree of calm, this is possibly the most important thing I can teach you for now getting through the next week, 2 month, year, and or the next 50 years of your life. If you can show up calm, then you won't get swept out by the herd. And you can see visually, this happens to be a visual the last 25 years where that people bought into the market in 1999 thinking nothing can go wrong and sold everything in 2008 thinking everything could go wrong. And this happens to be a 25-year scale, but this could play out day to day, week to week, as I often highlight in my video blogs. And according to the data this week, pessimism is over 50%, or 80% of people are worried about the future. Rightly so. There's a lot of logical reasons to be able to argue intellectually why that's the case. But when everyone agrees something else is going to happen is all I've ever learned. So I would pause a bit before you take something as gospel. I know I'm speaking a lot, but in the next 2 weeks, maybe you can listen to the people around you empathetically and compassionately without knowing. There's no certainty to what's going to happen, but you don't have to react in an emotional way and go to any extremes. This is really important. So hopefully we can, our job as a team can help you develop your personal philosophy and your path, whether it's 90% in equities or 60% in equities or 25% in equities, whatever path you're on, you're going to be uncomfortable at times. There's always going to be a period, a moment in time that you're going to be uncomfortable and someone's going to do better than you. And you have to be okay with understanding your own personal philosophy and the fact that you're going to be uncomfortable at times. And I had a client, a 90-plus-year-old client, loved that, used to tell me a concept called laughing tickets. So Blanche would say, remember the idea of laughing tickets. Everyone around you is going to say, they got out of the market before the crash and they got in at the bottom. Or some other version of that. They bought Bitcoin, or they bought gold, or they bought internet stocks, or they bought whatever the fad of the day, or weed stocks, whatever it is that's going to make them seem smart. The more that anyone bolsters of how smart they are, the more you should run the other way. Because the reality, as Blanche has taught me, is the person bolstering, boisterously saying they know and they're such a genius, they generally don't tell you about the 50 laughing losing tickets that are slid under the bleachers. So recognize everyone's a little bit, needs a little hubris at this moment in time, because we don't know what's going to happen. But if you're home the next 2 weeks, you realize you're going to have a lot of sirens calling on you to be able to tell you what they know. They know you got to do this, you got to do that, you got to do this, you got to do that. So our job is to try to help tie you to the post, make sure you're on the right path to be able to weather choppy seas. Again, just showing for a young person that is accumulating money, like this is, you got to look at it as buying, tuna fish. I got 3 cans of tuna at discount, or, I'm buying socks instead of stocks. I'm buying socks instead of stocks. You're buying stakes in businesses. And over time, if you own stakes in businesses over a long period of time, it will inure to your future self will be very grateful. I'm going to pause because I've just given you a mouthful, and I'm going to pass it over to Jason to talk a little bit about some of the things we've been doing on financial technology to focus on what we can control to be able to make an impact in your lives the best we can.
Thanks, Jonathan. Yeah, so over the course of the last year, we've done a really good job as a team to enhance our back-end technology. which is allowing us to take advantage of some of the opportunities that the market has given us. Again, you have to control what you can control, right? Nobody knows how long this will last, but you have to control yourself and control the knowns, right? So one of the things we've implemented is the ability to have the technology to do tax loss harvesting, effective rebalancing, and enhance their asset location abilities. And then we're constantly giving behavioral coaching, right? Because at the end of the day, having someone to talk to is the most meaningful thing to do. I was on a call with one of our clients the other day, and he was, basically he talked to us as like, we're their psychologist that helped them get through what was going on in the marketplace. And if you look at all the numbers, this is a study done by Vanguard. Tax loss harvesting can add 77 basis points to someone's portfolio, rebalancing 26, asset location 50 basis points, and just the behavioral coaching of making sure people aren't buying high and selling low and sort of giving up during downturns can add a total of 3% into the marketplace. And we've actually ran numbers on some of these things and asset location of what we're actually doing for our clients, and the numbers play out. So what have we been doing? Jonathan, next slide. One of the things we did a lot of on Wednesday and earlier on during the start of this downturn, it was tax loss harvesting for our clients. A couple clients have reached out and said, oh, they saw a bunch of different trades in the portfolio. What is this? What this was us doing proactive tax loss harvesting, and we sent notes out to a lot of our clients about this. And what we've done as a firm, we've harvested over $2.5 million of capital losses so far. And these aren't permanent losses, right? And so the way this works in reality is, we gave a little example below, is that if an investor purchases $100 of XYZ investment and the position drops to 90 and then rebounds to 10, there's zero tax impact because you never sold anything. It went down $10, went up $10, zero net benefit to that equation. However, if you bought the same position at 100, then it declined to 90, you sold that position and bought an equivalent but not identical position, right? So for selling Apple, buying Google, or selling one of the funds we own and buying an equivalent ETF that tracks the index, you can harvest that $10 decline where you can get that tax credit, and then if the market rebounds, you can still participate in the rebound. So that's what we've been doing proactively. And what this means, if you think about it from a 30% tax rate, right, which is somewhere in the middle of long-term capital gains, short-term, that accrues to about $750,000 in total tax savings. That's real money, right? So that's what we've been doing for a lot of our clients during this time period. We've also have been going through and seeing where clients can be rebalanced. If now they have a little bit too much cash or fixed income or flex mandate in their portfolio to own some more pure equities as well. So those are the things that we're trying to unemotionally, proactively do for our clients during this downturn. Next slide. And again, it's all about the process over your outcome, right? So growing up, I played a lot of sports. I played football in high school and was fortunate enough to play football in college. And my coaches have always taught me, right? Even my dad, who was my coach when I was younger as well, always focus on your process over your outcome. So your outcome when I was playing football was you wanted to win the championship, right? When I was in high school, we won the state championship. When I was in college, we came number 2 in the Lambert Cup and Division I AA. And it was always, okay, the championship is in December, but practices start in August. There's no way you're going to win the championship in December if you don't focus on your process that starts in August to win that championship. So that's one of the things that we always focus on with our clients as well. And in our terms, that's your need, your capacity, and your willingness. Your need is a quantifiable number, right? It's essentially what you need to get to your goal, whether you're in your accumulation phase of your life, or what's your spend rate plus inflation and taxes to continue your purchasing power if you're in the financial freedom stage of your life, right? Your capacity is your time frame and your balance sheet. And this is why we always focus on everybody's balance sheet, because if your balance sheet isn't healthy, your anxiety levels spike during times of market downturns. So when we talk with our clients, it's let's get your balance sheet clean first, so you don't have to think about the investing side, right? And then the final piece is your willingness, and that's different for me than it is for Jonathan, which is different for all our different clients. It's basically what's going to help you sleep at night. And this is the process that we try to go through with all our clients. And ultimately, if you focus on the process over the outcome should take care of itself. Next slide.
I just want to throw in one thing as one of our clients texted who knows this, that the immune system needs sleep to regenerate. So a good thing to remember and to prioritize was a really wise comment. And the reason, the willingness, we often talk about risk tolerance or risk profiling, like what I have seen in my 25 years of being in this industry is people's tolerance, as I showed you, for risk is high when they think things are safe, and it's low when they think things are not safe. So if we can focus on someone's balance sheet and realize that we don't know the moment in time that it's going to be safe or not, we want to create a risk profile that they're going to be able to live with through good and bad times. And in that respect, if we can do that well, you can live more fearlessly. These are examples of some of my influences over the year that have lived fearlessly. Just as a little comical aside, just to bring a little levity, I think humor might be beneficial in the next couple of weeks. The commonality, if anyone wanted to guess on a text what the commonality of all these figures is, there is a single thread that ties them all together. Anyone can guess, they can text me later, but the commonality is everyone's a bee except Munger and Musk. So Winnie the Pooh is a bear, just in case you wanted to know. So the best time to plant a tree was 20 years ago. The second best time is now. So in my trying to be a better leader and try to help make an influence on my own community, here's my little cheat sheet, and you guys welcome to steal this for your own health and wellness, because as the famous quote from The Godfather, good health is the most important thing, more than success, more than money, more than power. And obviously that's being tested for everyone, both real and or imagined. Physical and mental health is going to be tested these next couple of weeks. And so my little cheat sheet is to meditate over medicate. I've been journaling. This enables anybody that's creative to be able to come up and flush out ideas to be able to solve problems. Maybe, read an hour to 5 hours a day, instead of consuming, external data, read and think, spend time for thinking and energy, and maybe even take a walk in nature. I imagine nature is probably healing, maybe by yourself, not with others, maybe with an animal or a dog. Obviously on the wealth side, we focus on the planning side, someone's balance sheet, cash flow. We're here for you if you want to go over it in the next days, weeks, months, and or if anybody that needs help with their balance sheet, cash flow, planning, that they need a second opinion, someone to be able to get a perspective. And then of course, we want to have someone pay themselves first, protect themselves, be mindful about their insurance and taxes and estate work. Most importantly, work on their mentality, having an ownership mindset, thinking multi-generationally. Don't think about this moment. This crisis will pass. And during the next 30 years, there will be more crises, certainly. And it's not that they're not going to happen. It's how we're going to respond when they do happen. And then on the right, for your own wellness, for me, I've been eating a plant-based diet in a weird way. I know not to be too preachy on this topic, but I believe the coronavirus came from animals. If everyone was eating a plant-based diet, this virus would not happen. So if you really are environmentally conscious and conscious about the world, everything I read and everything I understand, plant-based diet is doing my little part that I can to make my own influence on my ecosystem. Exercise, stretch, do yoga, whatever you can at home. As we said, sleep. And if you have time that you're holed up with your family, how about playing some games? Do something fun, enjoy yourself a little bit. Try to make use of this time in a constructive way. Unstructured playtime can be helpful. So we want to thank you for the opportunity to do meaningful work and build meaningful relationships with each and every one of you. If anyone has any questions or comments, you're welcome to, throw it in on the chat board, and we'll try to get to them. There was a couple questions previously. I'll pass over to Jason to take on some of the questions that were thrown out via email yesterday. Want me to tell you what it was if you don't have it, Jason?
Yeah, I think you should read the questions for the audience, and then I can answer them.
I can do the first one, John.
Okay, go ahead.
So we had a client asking about the effect of significant losses in the IRAs on the RMD and whether the value of the RMD will decrease if the IRA decreases. So the effect is actually, there is no effect. RMDs are calculated based on the 12/31 values of the previous year. So they will, whatever your RMD is for this year, you have that required distribution for this year. And then they'll be recalculated this December for your RMD next year.
Okay.
Okay.
Next one, Jason, I'll share with you is clients of SAM understand their ups and downs. We've been invested for the long term. Is there some point, either by market measures or length of this new cycle, down cycle, or worldwide broadness of this economic collapse, or some combination of the three that we should start worrying, where we should start worrying?
Yep. So I think it all goes back to focusing on your balance sheet, right? And that's why we spend so much time with clients of making sure that their balance sheet is safe and they have enough cash to get through a variety of, depending on the client, anywhere from 6 months and some clients up to 3 years worth of cash sitting on their balance sheet. So we do not have to worry and panic during downturns. What you've seen is past downturns, we've all gotten through this together. And even if you look at the financial crisis, which was the worst downturn in modern history, from the time the crisis happened to coming back to where we were in the previous high levels, it took 2 full years. So that's why for some clients, depending on who you are, we make sure you have enough cash on your balance sheet. And again, at this time, it's best to be unemotional, right? They say, if you read quotes on Buffett and Munger, the best investors are not the ones with the highest intelligence, are the ones that can control their emotions the best. So again, to be unemotional, do some proactive things like tax loss harvesting, some rebalancing in client portfolios, because again, at the end of the day, we own businesses. Right? And a lot of our clients have made a lot of money through businesses. And we always pose the question, if someone offered you 30% less for your business today than they did 2 months ago, would you sell your business? And the answer we always get back is no, right? So that's the same thing that's going on today. Businesses like Apple, Microsoft, Coca-Cola, great businesses are now 30% less. So if you want to sell your own business for 30% less, then why should we sell other businesses for 30% less? So it's about a mindset and a framework and keeping cool through this environment.
I'd just like to add the idea of trying to make sure that people are prepared in advance, not in the midst of an emergency, but before an emergency. This is why having lines of credit and beyond your balance sheet are important. Not that you need it, but in the event that you protect yourself from being a forced seller. One of the worst things in the world in finance is a lot of the selling yesterday. It was articulated, some of it might have been margin calls. So some people are overextended, they have to sell. It's not that they want to sell, they have to sell. And hopefully we can protect people from being in that position. All right, so next question. Please discuss your strategy for handling the financial fallout caused by this pandemic crisis. Is it a different approach than in 2008? Is this uncharted territory for SAM? I refuse to look at my account during this time, but if the market's down 20%, does that mean my account is down 20% as well?
Right. So I'll answer the first question. the last question first, sorry. If the market's down 20%, does that mean your portfolio is down 20% as well? For the flat answer is no, right? It depends on when we go through the process over outcome, that's why we really focus on those three elements of need, ability, and willingness. And most of the times what that comes out to is owning at least some pure high quality fixed income and or a combination of flex mandate to make sure that you're trying to protect on the downside relative to the market declines as a whole, right? So if the market's down 20%, as of yesterday, roughly 28%, portfolios should not be down by that equivalent, mainly because you're owning some high quality fixed income in many of our clients' accounts and or flex mandate. And in terms of 2008, I'll let Jonathan answer in terms of SAM. I wasn't here in 2008, but I was at JP Morgan at that time, which many people know was the company that survived and thrived through the crisis. So 2 points to that. Number one, at that time in 2008, it was a seizure of the banking system, which is at the core of America and the global society. So when banks start seizing up, which is the lifeblood that pumps through the blood through the economy, that's where you see a lot of major issues, and that's not what we're seeing now. That's not something that's taking place right now. And those when I was there, it definitely feels like a lot different times than this. Additionally, if you think about the focus on just owning highly profitable businesses, JP Morgan at the time was the most profitable business in the banking system, and they had the best balance sheet. And so what you see by just focusing on the best businesses, which is a tried and true philosophy by Warren Buffett and Munger as well, is that when you have the best business, your balance sheet is clean, you're kicking off cash flow, you weather storms better, and you typically come out of the storm much stronger and more resilient versus as a whole and versus your competition. So that's relative to 2008 and sort of goes through sort of the process as well.
The comparison for me is, I started in the business in 1993. So there was several crises that, I lived through in the past. In 1998, there was Asian contagion and long-term capital management blow up where the markets dropped 20% in August to October of 1998. The Fed provided liquidity like they're doing now, and you saw markets, go parabolic in the end of 98, 99, and into early 2000. And funny enough, there was a quote. This is not to disparage anyone, but there was in late 1999, early 2000, people were so enamored with tech stocks as they remember that one of the famous commentators on screen was talking about how amazing the dot-coms were and how, value investing is dead and you should short Berkshire Hathaway. And it was fascinating because the subsequent couple of years, as the NASDAQ at the time that was, massively overvalued, there's a lot of non-profitable companies in the NASDAQ. Again, that's why we're trying to focus on profitable companies. The NASDAQ plunged over 60% in 12 months. And meanwhile, Berkshire gained 72% in the years to come. So, I think the principles and what's changed during that time, 2000 to 2001, when we had the 9/11 issue, and then we had a war going into 2003, and then even the Great Recession in 2008 and 2009. From 92 to 2007, we did not have discretion over anyone's money, so we couldn't implement systems and technology to proactively tax loss harvest and minimize the cost and the execution to be able to deliver a client experience in a more sustainable way. I had to rely a lot more on outside managers and rely a lot more and trust a lot of other people's decision making. So what's changed materially is we can control a little bit more of the process of focusing on what we can control. And that's helped materially on execution. It's not to say what performance is going to be day to day, week to week, but certainly on the execution and providing my ability to be able to have calm nerves through this, we can focus on what we can control and ignore the rest. So if there's any other questions, you can shoot your chat, shoot something through the chat box. Otherwise, we're going to wrap up and say thank you very much for listening to this first webinar. If you liked it, certainly provide feedback. We will make it available in a recorded fashion to share for those that weren't able to participate. And in the days, weeks, months ahead, if anyone needs assistance, we're here, ready and able to provide planning and investment advice to be able to be the calm through the storm and help tie you to the post so that we can get to sunny skies ahead. Thank you very much.